So with that, I'm going to ask each of my fellow panelists here to introduce themselves and their firm, give just a touch of background. I'll start off. So I'm a partner with HealthQuest Capital. HealthQuest is a $110 million fund that invests across healthcare, except we don't do biopharma. We're doing devices and diagnostics and healthcare IT and all the other stuff that doesn't fit in the box. And we're revenue stage investors, so we'll invest at the point of product launch or later, and typically invest $5 to $10 million into a deal. My own background personally, prior to getting into the venture business a couple of years ago, was as a medtech entrepreneur, mostly in kind of the device side of things, but I did do a brief stint in healthcare IT with a kind of e-prescribing startup a while back. So that's my operational background, but I look at most of the healthcare IT deals for our shop. With that, Akhil.
Good afternoon, I'm Akhil Saklecha from Artiman Ventrues. We are a early stage investment group based out of Palo Alto with an office in India. We have just over $1 billion in total management, although we're currently investing out of a $200 million fund that we closed this past summer. Now we have a little bit of a different perspective. What we look at is almost we're sector agnostic, so we'll look at any space, whether it's technology, life sciences, certainly part of it. Life sciences, it represents maybe 15 to 20% of what we do. And there's two partners that typically will invest out of the life science side in those areas. Now, our biggest areas that we look for are markets that are north of $10 billion. So it's a large addressable market, and which makes it sometimes a challenge for some of the medical companies we see. The other aspect is we look for white spaces, and white spaces that we define are wide open playing fields, no close competition. So the way to think about it is we looked at social networking, didn't really understand it, we missed it, but it was because it was too crowded for us to really get a grasp on it. And in life sciences, when we look at certain areas, we try to really understand the nuances of how the companies are differentiated. And typically the companies we invest in are very early stage. We'll invest in typically let's seed with the intent to do the Series A and then follow on. We'll typically invest in a Series A anywhere from 3 to 7 million, and follow-on money will be up to 15 out of our main fund. We also have a side fund that can invest, it's another $150 million pool of capital that we can invest another 15 to 20 million into a company. We have not really invested in biotech pharma. We've stayed a lot more on diagnostics, services, and we are heavily exploring devices. We've done software and healthcare as well. That being said, my personal background is I'm an emergency physician, so I typically look at a lot of companies with my physician hat on. I still work clinically as a physician, although very limited, and really am fascinated by what healthcare IT is poised to do.
Good afternoon, Rick Vandevenne of River Cities Capital Funds. We are currently investing out of our 5th fund that we raised last year, which is a $200 million fund, and we invest in healthcare and IT. On the IT side, we do B2B SaaS. On the healthcare side, we do medical devices, healthcare services, and healthcare IT. As a growth equity fund, we typically look for companies that have product or service that's in market, that's generating revenues, 3-4 million in revenues, up to maybe 40 or 50 or so million in revenues. And we invest nationally. I'm based out of the Research Triangle Park in North Carolina, and we have another office up in Cincinnati. So we sort of serve the rest of the country. There's certainly a lot of money that's sloshing around here in the Bay Area, with a lot of great entrepreneurs that are in other parts of the country. And so we are the 10% of the money that services the other 90% of the population. So.
I'm Phil Sanger from Texo Ventures, and our main office is in Austin, Texas, and there are 3 managing partners. We've been around for about 5 years. Initially started as a pledge fund, and then our investors wanted us to start a venture fund. And this fund, we started out with $25 million, and our next fund is to be $75 million. And basically, we're looking for companies that are in only healthcare. We want to make sure they try to improve the market efficiency, try to improve the clinical outcomes, and hopefully improve the patient experience. We like to find companies we not only invest in, but we also help to develop the companies and really work side by side in helping them with introductions to hospitals, insurance companies, and things like that. My background is as a pulmonary critical care internist. I practiced and did academic medicine, and then went over to the entrepreneurial level and have built surgical centers, imaging centers, laboratories, and have been active in consulting for HCA, and also for, was one of the original founders of a large Medicare Advantage health plan. So I've been active in the risk business. So we are interested in trying to find IT products and service products that work together, where we can help leverage our contacts with the hospitals and with the health plans, and help get our hands dirty in helping develop those companies. We presently have 9 companies today.
Hi, I'm Rich Simoni. I'm with Asset Management Ventures. We're an early stage VC firm based in Palo Alto. Have about $100 million under management. We are one of the oldest firms in Silicon Valley. We've been in operation now for 50 years. And so we think that's kind of cool. 2015 is our 50th year. We invest pretty broadly across technology and life sciences. In 2008, we explicitly tore down the silos between those two practices and made one of our focus areas for investing digital health. So we've been investing actively in digital health since that time, have about a dozen investments in the space. My own background is I'm a hardcore tech geek. I'm a PhD electrical engineer, became an entrepreneur, and did that for a number of years before getting into venture about 12 years ago.
So what I'd like each of the panelists to do, and Rich, I think we'll start at your end for variety's sake here, but maybe talk about the 2 or 3 subsectors or spaces within healthcare IT that you think are the most interesting and compelling right now. And then also feel free to identify if there's 1 or 2 areas that you're just allergic to right now for some reason.
Yeah, so this is kind of a weird answer to the question, Rick, but I think we don't really think of it in terms of sectors that we're interested in, sectors that we're not interested in. Rather, we think all of the sectors are interesting, but they're all hard for some reason or another. And so we're looking for companies within any sector, really, that is of some broad interest, that any company that has a unique angle of attack or a unique way of getting past whatever the hard problem is. So let me give you a concrete example. We're pretty interested in telemedicine right now. And there's reasons for that, right? The big name providers, they want to expand geographically, leverage their brands. The regionals, they want to protect their turf from incursions from CVS and the CVSs and Walgreens of the world that are trying to get into basic healthcare services. So it's an interesting space, but it's really hard because it requires behavior change by various parties, maybe consumers, maybe physicians, depends on the model, maybe both. So within that space, we're interested in companies that are that have some unique, unique idea, unique angle, unique distribution channel, unique partnerships that allow them to really crack that hard nut, which we think that's the hard thing about the sector. And so, we take a very broad view of the sectors that we're interested in, but within those sectors, that's where the rubber hits the road.
Well, we're very interested also in telemedicine and telehealth. We think it's going to be huge, but we also see that you've got to have it's a busy space, and you've got to have some sort of unique way of entering. We're interested in any sort of technology that has some sort of service kind of attached to it. And I'll give you an example. We have one company called SwipeSense, which is a company that basically gives you out disinfectant for the nurses, and we measure when the nurses wash their hands to try and prevent infections. And so we have a strong IT product, and we can give them how often the nurses are cleaning their hands to prevent, nosocomial infections, or what we call MRSA in the hospital. And that's a way of leveraging technology and leveraging service. So we like that. We've learned our lessons, at least I have particularly, of trying to deal with the large electronic medical record companies and trying to integrate them with things like CPOE. We've had a company where we would merge order sets, make it much more efficient for the doctors. But there's a group of electronic medical record companies that are very difficult to deal with and to integrate with. So, as I think Rick alluded to, it's finding that unique space where IT can leverage services in some way and has a unique manner of monetizing itself.
Some areas that I think are interesting, telemedicine certainly is one of them. I think the ability to look at activity-based costing and doing RTLS and sort of looking at the hospital as more of a factory, if you will, and trying to have units of work and understanding how you can optimize that leads to one might believe improved outcomes. So then that leads to big data analytics, and how can you use analytics to improve education within the hospitals? How do you improve nursing and physician education? More of the co-pilot sort of model and care coordination.
So I'll say what we've seen and what I think interests us. One of the biggest challenges in a lot of companies, whether it's diagnostic services or healthcare IT, is physician adoption. And I think Rick alluded to the fact that it can often be assumed that doctors will buy into the latest and greatest things, but what ends up happening is doctors are often tracking evidence, and they want to be swayed, but swayed by papers and evidence and patient trials, and that can be time-consuming, very expensive, and often prohibitive for startup companies. What impacts doctors is if you think about what is going on in the doctor's world, well, the reimbursement is going down. There's more and more time that's being spent in patient care, but they're not making as much per patient. So in order to compensate on income, they're seeing more patients per day. So it talks about efficiency. Their doctors have always traditionally waxed and waned on cycle of employment. Are they independent? Are they part of a group? Are they hospital employees, right? And so now we're seeing the birth of ACOs. And ACOs really, they're not a physical structure, but they're organizational structures of how physicians will operate, and reimbursement is tied into that. So really the key piece about all of that is understand the flow of money. And when you understand the flow of money, you'll see the opportunities that can exist. And I think that in healthcare IT especially, if you think about physician efficiency, think about ideas that will make them efficient as they see patients. So one company I think that just recently got funded is Medics, which announced a recent Series A. But when you look at what they're doing, they're making this whole model about how does a doctor record their interaction with the patient. They can do dictation, they can do templates. I don't know if there's any physicians in the audience, but every time I see a patient in the ER, I'm spending about 4 or 5 patients in face-to-face, 4 to 5 minutes in face-to-face time, but I'm spending about 10 to 12 minutes on documentation. So how do I make that 10 to 12 minutes in half, or even reduce it further? I mean, those are the things that I think as entrepreneurs, they need. That's what you need to be challenged in thinking about making a physician's life easier. And if you do that, and it's really tied into reimbursement and really tied into physician income, you'll see a bigger impact. Now, one of the other things that we're looking at very strongly is the theme of consumer health. And what I mean by that is there's more and more risk that the consumer, the patient, is taking on year after year. It's getting more and more. So if you look at your own health insurance deductibles, I'm sure that you've seen it climb year after year over the last decade. And because of that, consumers automatically become more attuned to saying, well, what is my healthcare costing? What can I do day after day to maintain myself in a healthier lifestyle? as well as what products are there that will allow me to really make myself healthy and prevent disasters from occurring, because that's what's going to happen. It's going to cost me money. And so we're looking at ways that we can orient healthcare towards consumers. And one of the things to think about, and I've not really seen a company, but I've been intrigued by this possibility, is we're seeing this first generation of wearables out there, and they give us data, but it's not meaningful data. You can get blood pressure, you can get heart rate, but at the end of the day, how does it really impact people? And for some people, marathon runners, it does influence them, but for the vast majority, it doesn't. But imagine if you can integrate all this disparate data that we have. If you can take an Outlook calendar, if you can take a wearable like a Fitbit, then in the next generation, which can give you heart rate and blood pressure, and if you know that, hey, every Monday from 10 to 11, my blood pressure skyrockets, but the software starts telling you that, you know what, every Monday you're meeting with your boss, and that's why your blood pressure skyrockets. So is there a way now that the software is telling me, what can I do about it, right? It's intuitive, but now there's something that's hardcore data that's telling me now what's the actionable step I can take. Well, before that, I really wouldn't know that I should attune my solutions towards fixing that problem. I mean, I think that, and as you start integrating more and more types of data like that, you'll start looking for opportunities that can have that meaningful impact.
Good. Yeah, so I think for us, there's a couple of things that we look for. I think first and foremost, we view ourselves as healthcare investors, and really fairly medically oriented healthcare investors. So the first question we ask ourselves is this really an IT product that just happens to identify the healthcare vertical as the market it's going after? In that case, we're probably not so interested in it. On the other hand, if it's something that impacts care delivery, impacts the patient, impacts the doctor's workflow day, something like that, then that's going to be something that we'll be, of course, more interested in. The other thing that scares us the most about the category, and I think Rich actually mentioned this at the beginning, or Rich or Phil, it is so noisy as a space, or at least a lot of the segments are very noisy, and that has been another filter, at least heretofore, that we've used, is if succeeding as an investment is depending on us picking the winner versus the loser within a host of competitors, we're almost certainly not going to make a bet in the space. On the other hand, if we're just betting whether or not the customer, whether it's the hospital or consumer or whoever, the customer is going to value this particular thing, and if that's the main bet, then that feels to us like something we can probably suss out. And then on the consumer side of things, I think we're a little more circumspect than you might be, Akhil. I think clearly the world's moving that way, so I think we're going to get there. I think we feel like there might be another generation or two before the businesses are really that viable, with maybe a couple of exceptions. If it's something that's consumer targeted but paid for by somebody else, like the payers or the ACOs or something like that, I think that could be viable, of course. And then I also think in the whole concierge telemedicine space, I think there's probably a market for that topic. So as you're looking at an investment in the space, what is unique to healthcare IT that you worry about and sort of dig on the hardest that might be different than some of the things you'd be concerned about with, say, a medical, more traditional medical device or something like that? Akhil, you want to lead off on that?
So I'll tell you there's a lot of stuff, a lot of parallels in how we look at medtech companies versus even companies in other spaces. And I think the biggest pieces are going to be around is this a must-have, right? So for any product company out there, especially in healthcare IT, is this a slam dunk? Is it solving a big enough problem? So as a physician, there's a ton of problems I have every day at work, and efficiency is one, the EMR is another, even figuring out what's the turnaround time of different tests. But what is the one thing that's going to make whatever company and product that you have is going to make me say, wow, I can't live without what you're trying to pitch. And I think that's really what you want, because adoption on the physician side, adoption on the healthcare administrator side, you're going to have challenges in every aspect of that business. But if it's a must-have, it will find its way to get adopted. And I think the other piece of that is solve a big problem. Don't solve a problem that is, something that is a $100 million market, right? Solve something in the billions, because you've got a limited bandwidth and limited touch points. Solve something that, when it gets adopted, there's enough groundswell and support that it's going to make your company a success.
One thing that I think is interesting is I do a bunch of investing, aside from life sciences. I'm a technology investor. And in the tech world, I often find companies that come in the door with a particular solution for a particular problem. It's kind of maybe it's a point solution, and I'm left thinking, is there going to be a bigger company behind this? Are there enough adjacencies? Are there enough growth paths that is there a big enough vision such that this can actually be a big company rather than just a company built around a single solution? And I find with healthcare IT and with digital health, it's almost flipped. There's some of the most exciting entrepreneurs have this vision of what the future is going to look like. It's going to be a brave new world. It's not going to be the system that we operate in today. And they're building their company with an eye towards that brave new world, and it's very aligned with all of the trends. All the trends that we see towards paying for outcomes instead of paying for process, et cetera, et cetera. The company's built that way, and I worry. I think to myself, is there enough of a short-term business here for this company? Because we've got the system that we have today, right? And do they have something that can incrementally add on to that system usefully in the short term, such that this company can get off the ground, and great, they can build towards that wonderful future. But what about building short-term revenue today? And so it's definitely I think about some of these companies differently than I do in the tech world.
Yeah, I know. One of the other things that makes me think of something else too that we've spent a lot of time thinking about lately, when you talk about some of these niche ideas, which I think in healthcare IT can be some of the more interesting ones, where they're trying to solve a specific problem, and even solving sometimes a relatively narrow problem, because healthcare is so big, it can still be $1 billion idea, even though it seems like some silly little narrow problem. But we also wonder about what internally we have come to call the Netscape effect, which is, Netscape was brilliant when they were the first browser out, or the main browser out, and then the day that Explorer got bundled onto Microsoft platforms, it suddenly became sort of not such a great idea. And so we worry about that, and we want to look at it and say, okay, is this something that Epic can bundle in, or Essen or MDON or somebody can bundle in with their existing products, and then we're going to be hosed, in one day or something like that. It's, of course, sometimes an unknowable question, but anyway. Any other thoughts on that topic before we move on?
Well, I think people need to recognize the sales cycle of other times is a lot longer in health IT than it is in regular IT, especially if you're dealing with hospitals or insurance companies. And it can be considerable because they'd rather not make a decision than make a decision. And that's been kind of the history of the large healthcare systems.
Yeah.
And obviously the HIPAA and the security things are a lot bigger piece than regular IT.
Yeah, an entrepreneur recently was telling me that whenever you propose change to somebody, you tend to get fight, flight, or freeze, and that increasingly freeze is the default.
That's a good way to say it.
Yeah, thanks. So I want to maybe twist that last topic, maybe 90 degrees or something, and talk about, is there something, as these entrepreneurs in the audience are positioning their company for investors, is there a piece of information or an illustration or something that they can make when they're coming to you to talk about their company that is particularly impressive or distinguishes them from other folks, or instantly sort of adds to credibility, some silver bullet that they can, maybe a piece of data that they can set a goal to go develop after this session that automatically sets them apart from the crowd?
So two things. One is a little bit tied into the question I was asked just a minute ago, is if you have an unfair advantage, I would push that out as soon as you can. And unfair advantage can be a lot of different things. It can be who you are. So if you were the CIO and CTO of a successful startup or from a large industry company, whether it's on insurance, payers, hospitals, you want to push that out as soon as you can, because as soon as you do that, the attention that you get from any VC is going to be amped up a little bit. A lot of VCs have ADHD, and easy to go to your phone, easy to go to your computer, and it's, we try not to do it. Unfortunately, it's something that happens because these things are really appendages that are attached to us. But I think if you have an unfair advantage, whether it's who you are, whether it's what you're doing, the fact that you just signed up Kaiser, or you just signed up a large physician organization like Team Health, those type of things, when you touch 1,000 physicians right away, it gets the attention. So I think that is the biggest thing. However you can get it across to whenever you're pitching, that's what you want to do. The second piece, and the tail end of that, is after your pitch, you really want to kind of see what is it, can you read the VC's face at all about what, how'd the meeting go? Did you lose them somewhere? Is there a follow-up? Is there specific questions? Always make sure that you've got enough information and a follow-up question or follow-up email that you can send them that's going to keep them engaged in the game, because we will often fall off. We get so many emails every day, it's hard to keep up, and things can get lost, forgotten, and so you want to make sure that you have something very crisp, tangible that you can follow up on.
I would say that much like on the IT side of the house, there's some metrics, especially if it's a SaaS company, around cost of customer capture, that's important. I think something that's important more specifically to healthcare IT, when you do land a big account, is utilization, right? I mean, how many doctors are actually signed up on the platform, and that kind of points to how many of those big systems are likely going to churn off in a year or two because they just never really got adoption, right? So it's one thing to be able to sort of sell something on the front end, the big vision, but are people actually using it and seeing value to it?
Day-to-day usage.
Day-to-day usage trends, right? So that would be important information.
I too think a couple of good reference accounts and increased utilization and good references are going to be the most important thing that we look at after obviously the team and things like that, and the product. We want to make sure that it's gotten out there and it's referenced and somebody's using it.
And for us, it's a different way of saying what you just said, Rick, is that, for me, it's all about validation of the business assumptions that you've built into your model. There's a number of assumptions. You won't be able to have, at a very early stage, you won't be able to have them all validated. You'll be making up numbers for them that you hope are reasonable, hope you can convince somebody that they're reasonable. But I'd rather you use, for instance, let's say you've raised some seed capital. I'd rather you use that seed capital to go validate the key business assumptions than to just grow the business in a way, for instance, that isn't the same way you would grow it once you had more capital. So I'd rather see less revenue with more assumptions validated in the marketplace than the growth that you might have bought with that seed capital.
Actually, I think it's a great point. I was having that conversation with an entrepreneur just earlier today that it's really about answering questions and strategically thinking what are the questions that have to be answered over the next year or 2 years or something like that. Okay, so let's touch the third rail here and talk some about valuations. And so I'd like to get people's thoughts on maybe two things. One, just general, where you think the trend on valuations is going. Do you think about, as an investor, valuations differently in this space than you would, again, in maybe another IT space or another medical product kind of a space?
I mean, we don't think about it any differently than we do anything else. To us, it's just a market, capital market, and supply and demand kind of drives the valuations. I think that as venture capitalists, usually around the same time that that startup valuations are high, our exit valuations are also high, so that kind of takes the sting out of having to pay a higher price to get into the companies. But that does create issues with cyclical returns across vintage years and in venture. But I think right now to be an entrepreneur, it's a great time. There's a lot of capital available at good prices. I think if I had a piece of advice for entrepreneurs around that, it would be, you may be able to raise capital at a nice valuation, but you also may be kind of getting ahead of the valuation that you would receive in if the market were to turn down. And so take those things into account, create a spending plan, an operational plan for the money that you raise, such that you'll at least be able to grow into that valuation, even if you were to end up at the end of that runway in a down market. And another good thought experiment is to say, well, at the end of this, let's say I raise this money and I've got an 18-month runway. At the end of that 18 months, could I probably won't be cash flow positive because I'm growing and I'm plowing money into the business, but could I be cash flow positive if I had to be? If the capital markets dictated that I had to be self-sustaining at that point, could I take drastic measures and be there? And, maybe I'm old school, but if the answer to that is no, then, my advice would be to try to rejigger things. But, it all depends on the stage and what the goals are as well. So your mileage may vary.
Yeah, and I totally agree with that. I mean, you don't want to push that early evaluation up so high that you're going to have a down round and upset your investors and not be able to raise enough money going out there. And IT is a little bit overpriced. I mean, we talked about Caslight. I think they need 12 million, not 13 million. It went out as a $1.3 billion, $1.4 billion company. I tried to short it myself, but it takes a month. You got to wait to short it. So there are a lot of overpriced IT products out there. But starting as a new company, you don't want to try to price those rounds so high early that it's going to hurt you later on when you start needing other investors or your investors to come aboard and they're taking a down round.
Yeah, it's a little bit of a dangerous market, I think, for investors. I think it's fantastic as an entrepreneur, because these valuations are so high what people are paying. And I think you have, as I mentioned earlier, a lot of IT investors coming into the market, and that's that sort of demand, right? So they're kind of driving up valuations certainly pretty darn high. But when you look at the public markets, First Analysis just came out with a report a day or two ago that looks at the public healthcare IT companies, and I think 23 out of 30 of them their stock did not perform as well as the overall S&P. So it's not as attractive from the public markets perspective. And a lot of money has flown into the system over the last couple of years, 40 billion or so, and taxpayers paid for most of that. Right? It wasn't really the hospitals who paid for it. So I think now, hospitals typically have like 2.5% margins. I think that's probably about right. And if it comes to them and they have to spend it, and they're basically trying to figure out, well, do we want to buy another MRI machine, or do we want to buy some extra cool software that's going to show up on our doctors' iPads? I mean, that's the decisions that they're having to make, and they might not make those going forward. So the last thing we want to do is buy high and sell low, right? You're not going to be around as a fund if you do that too often. But I think there's certainly some very exciting, some huge trends that will be great areas for investment. You have to be careful.
Not much more to add. I think I tend to agree with all of those responses. I think the biggest thing is it does depend on, even when you're in digital health or any aspect of healthcare IT, it's the problem that you're solving, and that's the valuation that it deserves. If it's a huge problem and it's something unique and it's a big execution play, we're going to invest in the team, and I think valuation-wise, you do want to be cognizant about what you value a Series A company, because Series B is in this market is getting a little bit tough sometimes. There's a big void there, and as soon as you get past that hurdle on the growth side, then obviously Series C can fall into place. But I think the answer still is it depends on valuation.
So what about early exits?
Yeah, I mean, we see lots of little tuck-in acquisitions by some of the bigger healthcare IT vendors that are trying to position themselves and take advantage of the aura that's being created in the public markets for other companies that are similar. You know, I mean, I think the acquisition of Change, Health, which is a similar company to Gaslight, for 20 times or something like that. That was by MDN, right? MDN trying to position themselves a little bit better, perhaps.
So both are pretty later stage.
Well, okay, so it depends how you define that later stage, right? It's all whatever lens you have. But.
Yeah, I think there's actually a lot of I think tuck-in is actually the right word to use here. I think there are a lot of relatively early things that are getting picked up by these companies as these, I'm not exactly sure what the strategy is, to be honest, in some of them, but as these little tuck-in acquisitions. The problem is that very rarely are you able to get any information on what the company actually sold for or any of their metrics or anything like that. So it's hard to really know, did they pay $3 million for it and nobody really made any money, or maybe they paid some significant amount as a multiple, but it was so early in the company's life that it still didn't get disclosed because,
So have any of you seen any of these?
out of our portfolios,
Yeah.
not us. No.
Yeah, I mean, we're not in the business. I mean, we're trying to scale companies up to a large enough size. So if we're putting our money to work and you can get something back quickly, it's usually not going to be a very high multiple. So, we're trying to balance those two things, especially if you're paying up on the front end, right? You need the company to run for a little while to create that value.
That's true. Jonathan?
Yeah, aside from health IT pure plays, are you seeing a trend where traditional biotech companies, whether it's a therapeutic device or diagnostic, are utilizing next generation IT or analytics to improve either the efficacy or accuracy of their products? And if so, how do you view those opportunities as investors?
I have a company that I'm very excited on. It's a diagnostic company, and there's a significant component of bioinformatics that's being applied there. And I think there's a lot of value, because anytime you apply bioinformatics on top of diagnostics, you improve the odds on not only and I want to separate, the diagnostic will have sensitivity and specificity tied into it, but when you add bioinformatics on top of that, the overall accuracy and the meaningful impact that test has gets to be very significant. And I think we'll see that a lot as you look in how these the biotech companies are evolving to use bioinformatics, and separate from other software plays, but how they're using bioinformatics to improve the aspects on drug development as well as on the diagnostics